All right, today we're diving deep into a massive sector, consumer electronics. It's really where cutting-edge tech meets everyday spending. We've got a detailed screener report on three key stocks, Apple, Sony, and Sonos. Each one tells a pretty different story, right? Let's unpack this.
Exactly. Our mission today is a rapid-fire analysis of these three. We're pulling together the fundamentals, the technical signals, key news, basically giving you an expert journalistic take on where things stand.
Yeah.
The goal is quick, comprehensive insight.
Okay, so we'll tackle them one by one. We'll look at the core financials, see what the charts might be telling us, touch on the latest headlines, and then we'll wrap each one with a bit of fun, like paper money math, just seeing what historical performance could have looked like based on the data.
Sounds good. And just that one crucial reminder up front. Everything we discuss is based purely on the public data we have here. It's for educational purposes. This isn't investment advice, and we're definitely not telling anyone to buy or sell anything, just laying out the analysis. Got it. Let's jump in. First up, the behemoth, Apple Inc. I mean, the market cap is just staggering, $3.74 trillion. It's almost hard to comprehend that scale.
It really is. And the profitability metrics, they definitely stand out. Gross margin over 46%, profit margin above 24%. That's impressive.
And those efficiency numbers, too. Return on equity near 150%, return on invested capital over 66%. They're clearly making money hand over fist.
Undeniably profitable. But here's the catch, or maybe the point of discussion,
Yeah.
the valuation. That trailing PE is up there at 38.36.
Okay, high, but maybe justified by growth.
Yeah.
The forward PE is a bit lower at 31.51.
Right, suggesting growth expectations. But look at the price-to-book ratio. It's like 56.94. That's extremely high.
Whoa. So what does that even mean? If it's not valued on its physical assets, what are people paying such a premium for?
Great question. You're paying almost entirely for the intangibles, the brand, the ecosystem lock-in, future innovation, the services business. It's all baked in. The market is pricing it for continued dominance and massive growth. And to be fair, they've consistently delivered that. Makes sense. Okay, one thing that caught my eye in the financials, though, the liquidity. Current ratio is able 0.87, quick ratio able 0.83, both below 1. How does a giant like Apple operate with, well, seemingly tight short-term liquidity?
Yeah, it's interesting, isn't it? It reflects a very specific operational strategy. Below 1 means short-term liabilities technically exceed short-term assets. They manage cash flow incredibly tightly. Think just-in-time inventory, but for cash. They rely on constant high-velocity sales to cover obligations, not big cash buffers.
So it's aggressive, something only a company with really predictable income could pull off.
Exactly. It's efficient, but you need that confidence in your cash flow cycle.
Okay, shifting to the technicals. Wow, the momentum looks incredibly strong. Performance this quarter alone is over 25%.
Yeah, the price action is powerful. The current price is way above the 20-day, 50-day, and 200-day moving averages. That's a textbook uptrend signal, short to long term.
Screaming buy based on trend then.
On trend, yes. But here's where technical traders pause. Look at the 14-day RSI, the relative strength index. It's sitting around 68.88.
Okay, 68.88. Why is that significant if the trend is so strong?
Because it's getting very close to 70. And 70 is often seen as the threshold for an overbought condition. So you have this conflict, strong underlying trend, but the RSI is flashing a warning sign, a potential sell trigger for short-term traders, suggesting maybe it's run up too fast and could pull back or consolidate.
Momentum versus potential exhaustion. Got it. And news-wise?
The buzz seems positive. Lots of talk about strong iPhone 17 demand, analysts hiking price targets Wedbush to $310, for example.
But here's a twist I saw. Intel is apparently seeking investment from Apple as part of Intel's big comeback plan.
Yeah, that's a fascinating development. Puts Apple potentially right in the middle of the whole semiconductor manufacturing push. Very interesting strategic angle.
All right, let's do that paper money math for Apple. Say someone hypothetically invested $10,000 at the 52-week low of $169.21.
Okay, at that price, $10,000 would get you roughly 59.1 shares.
And with the recent close price, around $252.31.
That hypothetical $10K investment would now be worth about $14,903.
So that's a $4,903 a quarter over paper profit, a gain of, what, 49%?
Yep, 49.03% over that 52-week period. A really strong return, which, helps explain why investors tolerate that high valuation.
Well, okay, let's pivot from the absolute giant to Sony Group. Still huge, $176 billion market cap, but a very different beast, right? A diversified conglomerate based in Japan, trading as an ADR here.
Completely different profile. And you see it immediately in the valuation. The PE ratio is 23.22, much, much lower than Apple's.
And the price to sales is low too, just 2.10. Their EPS was negative this past year, though.
It was, yeah, down about 5.45%. But analysts are expecting a rebound, projecting EPS growth next year around 12.41%. So optimism is there.
What really stands out to me comparing it to Apple's tight books is Sony's balance sheet. It looks incredibly clean.
It really does. Debt to equity is super low, 0.19. Long-term debt even lower relative to equity, 0.16. And those liquidity ratios.
Right, current ratio 1.09, quick ratio 1.03, comfortably above 1.
And that's the connection, right? That healthy balance sheet, low debt.
Hmm.
It points to fundamental stability. They have flexibility. They can weather storms, fund new things without being heavily leveraged.
And the stock performance seems to reflect that longer-term stability. Year-to-date gain is strong at 38.66%, and the one-year return is impressive, over 57%.
Excellent long-term performance.
Mm-hmm.
And technically, what's interesting is the RSI is pretty neutral right now, around 58.45.
So unlike Apple, it's not showing that overbought warning signal.
Exactly. You've got strong performance, a stable financial base, a more reasonable valuation, and the technicals aren't screaming caution in the short term. It's a more balanced picture, you could say.
Looking at the news, it seems their diversification is really paying off. I saw headlines about the Demon Slayer anime movie just smashing expectations.
Yeah, that's a huge hit. It really shows the power of their entertainment divisions, games, music, movies. They can drive growth even if the electronic side faces issues.
And they did face issues, didn't they, with tariffs?
They did. They had to raise PS5 prices because of tariffs. But then, interestingly, they actually raised their annual forecast later. They said the tariff hit wasn't as bad as feared, and demand for games and music remained really strong. So diversification, helping them navigate that trade friction.
Okay, let's run the numbers for Sony. Let's use that year-to-date performance, the 38.66% gain. Hypothetical $10,000 investment at the start of the year.
All right, applying that 38.66% gain, your $10,000 would grow to approximately $13,866, or actually closer to $13,858 based on rounding the percentage slightly differently. But let's call it $13,858.
Okay, so that's a $3,858 paper profit just since the beginning of the year.
Yep, a solid 38.58% gain year to date. A very respectable return from the stable conglomerate.
All right, third stock, Sonos. We're going from the global giants down to a niche player. Small cap, just $1.83 billion market cap, focused purely on high-end audio. Totally different ballgame.
Totally different. And this is clearly the high-risk, high-reward play of the three. The financials tell you that right away. PE is listed as dash, undefined because earnings are negative. EPS trailing 12 months is negative $0.65. Operating margin, profit margin, both negative.
So fundamentally, it's losing money right now. Red flags there.
Definitely. You're not buying this based on current profits, that's for sure. You're betting on a future turnaround.
And the risk level seems amplified by the stock's behavior. That beta is really high, 2.25. What does that mean in simple terms?
It means it's volatile, much
Yeah.
more volatile than the overall market. If the S&P 500 moves up or down 1%, Sonos tends to move about 2.25% in the same direction, on average.
So bigger swings, both up and down.
Precisely. Magnifies gains, magnifies losses, higher risk.
Okay, but despite the negative earnings and the volatility, look at the recent performance. An incredible surge last quarter, up almost 41%.
Yeah, 40.93% in just 3 months. That massively outperforms its longer-term track record, which is actually still slightly negative over 3 years.
Which brings us to maybe the most interesting part here, the insider activity.
Absolutely. This is where it gets really intriguing. First, institutional ownership is already super high, like 93.6%. Big funds own almost all of it.
Okay, so the smart money is already heavily involved.
Right. But then you look at recent insider transactions. The data shows a figure of 104.46%. That indicates massive net buying by insiders recently.
Wow, insiders buying more than 100%. How does that work? Is that relative to shares outstanding or something?
It usually relates to the volume of insider trades over a period, often compared to total volume or float, signaling very significant net buying activity. Specifically, the source mentioned Coliseum Capital Management, a major 10% owner, buying heavily in July and August.
So management and major owners are putting their own money where their mouth is, despite the red ink on the income statement.
Exactly. That's a powerful signal of conviction. For traders who follow insider sentiment, that's a potential buy signal, overriding the weak current fundamentals. They believe a turnaround is coming.
And the news seems to back up that turnaround narrative. New permanent CEO Thomas Conrad, focus on efficiency, trying to win back customers after some kind of software fiasco.
Yeah, they're clearly in operational recovery mode. trying to fix things internally and rebuild trust.
And analysts seem to be buying into it, at least looking forward.
Apparently so. The projected EPS growth for the next 5 years is pegged at a huge 45.57%. That implies expectations of a very sharp recovery from negative earnings. It all hinges on execution, of course.
Let's run the simulation on that recent explosive quarter. A hypothetical $10,000 invested 3 months ago to capture that 40.93% surge.
Okay, a $10,000 paper investment riding that quarterly wave would now be worth about $14,093.
That's a $4,093 paper profit in just 3 months.
Correct. Highlights the potential reward side of that high-risk profile. Quick, significant gains are possible if the momentum holds and the turnaround story gains traction. Hashtag conclusion and final takeaway.
So wrapping this up, this deep dive really shows the incredible diversity within just one sector, consumer electronics. We've got Apple, the titan, fundamentally strong, but demanding that huge valuation premium, and maybe flashing a short-term technical warning with that RSI.
Right. Then Sony, the diversified giant. More balanced valuation, solid financials, really impressive long-term growth driven by its entertainment wing. Less technical risk right now.
And finally, Sonos, the small, volatile turnaround play. Negative earnings, high beta, but with this recent explosive momentum seemingly fueled by, well, intense insider conviction.
Yeah, the risk profiles are just dramatically different. Apple is paying for perceived safety and continued growth. Sony offers maybe growth at a more reasonable price with a good balance sheet. And Sonos, that's the pure speculative bet on management execution and market sentiment backed by those insider buys. It's a conviction trade.
Which leads us perfectly into our final thought for you, the listener, to chew on. We saw Sonos management and major owners buying shares aggressively this summer, real skin in the game. But the source data also shows that over the past year, numerous Apple insiders, including the CEO and CRO, have been selling significant amounts of stock.
That is a stark contrast.
So the provocative question is, what might this difference in insider behavior, buying at Sonos, selling at Apple, suggest about where the people who know these companies best actually see the most compelling future value creation? Something to think about. And that gives you a rapid expert-level view of the key players and dynamics in consumer electronics right now. That's all the time we have for this deep dive. Thanks for joining us. We'll see you next time.